everyone, welcome back to our Accounting 210. In this video, we continue with the chapter 10, the ungraded practice. So we continue, right? So let's get started. Next one, question 14, also talking about responsibility center. You should know those things we talk about that. So you should be able to get that one. Decentralization, also make sure you understand that part, the definition, advantage, disadvantage, and then still, those responsibility center. I skip those one. Sorry, I skip those one because you can find your answer very easily from the My Accounting Lab, right? Difference between actual and the budget is no, right? Actual and the budget is called a variance. This is wrong. This is not called decentralization. A favorable variance causes operating income to be higher. Yeah. So make sure you understand those concepts. Performance report compares actual revenue and expense with budget, the revenue and expense, right? So we compare actual with the budget. We compare actual with the budget. Next one, manager can increase ROI by doing what? So let's look at this one. Let's look at this question. So asking about ROI. ROI is operating income divided by total assets, right? Divided by total assets. So you want this one to be higher than either you increase your numerator or decrease your denominator. So we either increase, so you want to increase this, you can increase, no, you increase your denominator, that's wrong, you should decrease your expense, then you will increase your income, right? So you will increase your income. Decrease your sales, no, increase operating, no. So answer is B. See, this is another way to test you, right? So I may not ask you the calculation. I may ask you, say, hey, this one said that you increase ROI. In the exam, I can ask you, how about decrease ROI, right? Change some numbers, change some words, you will have a different number. Let's look at this one. I think this one is similar with your test, with your assignment quiz. So I'll just go very briefly asking about sales margin. It equals to your sales margin, operating income divided by sales. And you just get operating income and then divided by sales. 40%, I even can get a number here, right? So make sure you don't be confused by extra information. We don't need to worry about the extra information. How about this one? Says, what's this one? Your ROI is 22%, operating income divided by total assets is 22%. And total assets is 6.1 million. So you should be able to get operating income then, right? You should be able to get operating income. Telling you current liability, we don't need to worry about that one. So you should be able to get operating income. How do you get operating income? Your operating income will be 22% times this 6.1 million. So it will be 1.3. Answer is this one. I think this is also a good question, right? Instead of telling you, asking about your ROI, hey, I tell you total assets, I tell you this, I ask you about your operating income. The logic is whenever I tell you two numbers, you should be able to get the third one. Next one. How about this one? That your operating income is this, sales margin is this. So your margin is 25%. Operating income is 74,000. So you should be able to get your sales, right? So you should be able to get your sales. I'm not doing it. You should be able to get your sales. And then capital turnover. Oh, you don't need to even get this one. So asking about your ROI. So ROI equals to sales margin times your turnover also. So will be how much? 25% times 1.6 gives me 40%, right? So you can say how I test you. Make sure you, once you understand the formula, you will be the 10, you will be the 10. I don't worry about you actually. This one margin is this, target rate of return, capital turnover, operating income, sales. Okay, so asking about your sales. Say operating income is 50 8,000. We want to know the sales, but it also told you your margin is 10%. So your sales has to be 500. It has to be this one. Straightforward. Straightforward. Next one. Target rate of return. Asking you about what? What's the total assets? Okay, total assets. Asking about your total assets. Okay, total assets. Total assets. Now you can do it very easily. Your ROI is 10% equals to operating income 159.5 thousand divided by your total assets. The total assets has to be 1.5. Wow, why I'm so smart. Next one. ROI. I'm not going to do it, so you can play with the numbers by yourself, right? Sales margin also very easily. It's just your operating income divided by sales. Don't be confused by your extra information. That's all I want to say. Okay. So we go to the next topic is the variance. It's the variance topic. So let's look at this one. Volume variance, the difference between actual and flexible. No, actual and flexible is called flexible budget variance. Volume variance is flexible and your master budget. Next one, which of the following cause a favorable sales volume variance? Okay, so we have actual, we have flexible budget, we have our master budget, So this is called volume variance, and then it's asking about your sales revenue. So how will you cause a favorable? That means your flag is your actual time, your budget. This is your budget time, your budget. So that means if it's favorable, that means your actual units has to be more than the master budget units. It's about the units, it's about the volume. Okay, so actual sales in dollar. Okay, let's see. Okay, but it's asking about, okay, all the variable actual sales in dollar greater than the master. Okay, then I think that works. Flexible budget. No. It has nothing to do with the actual. So it's about the flexible and the master. Flexible budget in dollar are greater than the static budget, right? It has nothing to do with our actual and flexible. This is called flexible budget variance. But we talk about volume variance. Next one. Unfavorable volume variance for variable expense would indicate that. Okay, unfavorable, that means your cost is more than the standard budget. Okay, expense of company were less. No, actual variable. No, it has nothing to do with the actual. Units were actually sold. No, let's see. Fewer units. Asking about the expense. Fewer units were actually sold. No, fewer. Volume variance. No, this is not about the actual. The expense of company were less than. The expense of the company were less than what had planned. That's wrong because that will be favorable. Actual were higher than the flexible. This is flexible budget variance. Sold than the company had anticipated. More units were sold. This is a good question actually. Oh, okay, I see. Okay, so this is about the units. Sorry about that. See, I don't know everything without a textbook, so you have to make sure you read textbook. It's asking about your volume variance. So we think about the units, right? We think about the units. Unfavorable volume variance. Okay, more units were actually sold than had originally budgeted to sell. I'm not sure. Okay, so the answer is that think about a variable expense. Okay, think about variable expense as our sales commission. Okay, think about as our sales commission. So it tells you that you have an unfavorable. That means your sales commission is more. Your sales commission is more than the budget. Why you have a more sales commission? That means you sold more units, right? You sold more units than the master budget plan. You sold more units than the master budget plan. That is why you have an unfavorable volume variance. That is why you have unfavorable volume variance. You sold more units. You sold more units than you originally planned. Next one. Let's look at this one. Okay, I think this is also similar with your some of the quiz. Let's look at this one. I just picked some question. I didn't honestly. This is my first time to really do the numbers. So if I waste your time, you think I talk nonsense, forgive me. It's also my first time to do these questions. I'm being very honest with you, So now this one said a graph of flexible budget said fixed cost and then total cost will be this. Okay. So your flexible budget, actual flexible and master budget, your total cost is, okay, so you have a variable cost will be 70,000 and the fixed cost is 40,000, right? Because total is 110,000 and then the volume is 7,000, So that means your variable cost will be 7,000 times $10 each. Am I right? 7,000 times $10 each. 7,000 times $10 each. Assume the relevant range is this to this, and then the graph will reflect a total monthly cost, and this will be, okay, so this is a good question. So for our total assets now, your variable cost, when the volume is 7,000, it will be 7,000 times $10 each. Now your volume is 18,000. So your total variable cost will be 18,000 times 10 gives you 180,000. And your fixed cost will be still 40,000. So your total cost at volume of 18,000 will be 220,000. So what this question is trying to test you is your flexible budget. Your flexible budget is based on different volume. Next one, I think it's very similar. I think I put many questions similar with this one. The budget selling price is this variable rate is $10 per, and budgeted fixed cost with this was a budgeted operating income for 3,500. Okay, so I think we did this in the assignment, right? So it's asking you about your operating income. It's your revenue minus all the cost. So the revenue is you are selling at 3,500, and each one selling price is 45. Your variable cost is $10 each minus 3,500 times $10 each, and then minus your total fixed cost 20,000. So one more time, it just use our actual output. If we use the actual volume, you will get your flexible budget. Flexible budget is based on your actual volume. Want to double check? I'm not really sure. Okay, so let me double check. 3,500 times my contribution margin and then minus 20,000. So my answer is 102. Perfect, right? Next one, what's the budget operating income? So it's very similar, right? It's very similar. Let's see, it's 700,000 each. Variable cost is this, fixed cost is this. Above fixed cost will be this. Okay, so we don't need to worry because it's not above 1,500, the range. So your range is still the same. So fixed cost will still be 20,000. So it's similar. So if I put the number, it will be 700. Okay, now your volume is, if I do this, I'm not going to do it. It will be 1,300 times 700 minus 1,300 times 100. This gives you revenue minus variable cost and give you contribution margin minus all the fixed cost. Your fixed cost now is still 20,000 because your volume 1,300 is within the range of 0 to 1,500. So it will be still 20,000. Next one. Okay, now it's different, right? So now it's different. So because your fixed cost will be different, So our revenue minus variable cost minus fixed cost. Our revenue is 2,500 units, and each one selling price is 750. We minus variable cost, each one is 500. And now we minus the fixed cost. Volume up to 1,100, above 1,100, fixed cost will be 60,000. Now we have to use this 60,000. Okay, so if you do that, you will find your operating income will be, we do it together, so 2,500 times 250 contribution margin minus 60,000. So that gives me my operating income will be choice A. Right. Next one, asking you about very similar, right? So this one will be similar with the one we just did, I'm not going to do it. You can do it by yourself. So your revenue will still be selling price minus variable cost, but now your fixed cost will be above 2,400 because you have 2,600. Last one. Yeah, last one. I'll leave it to yourself, but I can do it. Employee is your learning and growth, right? Learning and growth. Okay, I think that's all I want to cover. I think if you ask me those questions, I practice, but I think this one maybe is a good one. If you want me to point out what is, I think this one is a good one. This one is a good one to practice. The main idea is a flexible budget variance is the actual output level. Okay, master budget is the static level. Flexible budget is very flexible. It's the actual output level. Okay, then I stop here. I think chapter 10, make sure, as I said, know those 3 parts and then read the concept by yourself and be ready for the exam. Thank you. I see you next time.